we were speaking with Kathleen, who's the research director at XTB, in the last kind of like video that we posted, and we were talking a little bit about the market outlook for 2025 against the backdrop of tariff wars and what's going on with Trump and his tactics at the moment. What we want to do in this episode, though, is talk a little bit about global markets overall to see if there are any unexpected winners that perhaps you can keep an eye on or something for you to bear in mind if you're looking at tweaking your investment strategy moving forward. So I'm really, really pleased to be joined again by Kathleen from XTB. Thank you so much for coming back.
Thanks so much for having me back, Peter.
First question for you then. In the last episode, you mentioned the fact that Europe has done pretty well. Are there any regions that are poised for, the strongest economic growth in 2025 as you guys are seeing it from the data and the information you're coming across at the moment?
Yeah, I mean, there's been a flurry of revisions to economic forecasts for 2025, but it seems like at this early stage, there's a bit of a consensus that the US will still outperform in the G7, even though its rate of outperformance has definitely slowed. What's really been interesting, and will be interesting probably for a lot of your viewers, is that the UK is poised to be the second best performer in the G7. So it's expected to outperform the likes of
Oh, really?
Japan,
Okay.
outperform Europe, and that's based on OECD forecasts at the moment. So growth has been scaled back a little bit for the UK, but it is expected to do better. So aside from the US, then it comes in as second place. Now it's overtaken Canada because Canada's growth has obviously been slashed in half. Its growth forecast for this year and next year has been slashed in half because of its close proximity to the US and the fact that the focus of tariffs is very much on Canada, likewise Mexico, which is expected to go into a recession. Now, what's conspicuous by the UK's absence really is tariffs. So Donald Trump has actually struck a fairly friendly tone with the UK. It hasn't threatened tariffs on the UK. It has obviously on the EU. That's expected to dent EU growth, and that's having a big impact there, particularly on certain sectors, autos, for example. But the UK, in terms of its growth prospects, is expected to do well. Now we started off on a bit of a dud note because growth unexpectedly contracted in January. So these are just forecasts. They can be revised up and down throughout the year as well. So it's just worth noting that. But what it certainly does do, it could maybe help investors just to maybe take a second look at the UK. I think one of the key themes that we didn't see coming this year was maybe that defense theme. We knew that Donald Trump had said, leading up to his inauguration, that he wanted peace in between Russia and Ukraine. We didn't quite realize that that would mean the catalogue of events that have happened since then, with the US threatening to stop military aid to the Ukraine, telling the Europeans they need to pay more, they can't rely on the US for their security anymore. That has triggered a massive inflow into European and UK defense stocks, and they are the best performers by far so far this year. Germany has a lot of them, France as well, but also the UK. We've got BAE Systems, Rolls-Royce as well. They're the top performing stocks in the UK this year. Rolls-Royce has been a top performer for a number of years now. But those stocks have really, really done well, and they're able to cover over some of the damage that maybe Donald Trump's tariff policies have done to the auto sector. It's weighed quite heavily on the luxury sector as well. So we've seen that the diversification that European markets offer has really come to the fore, and that's why European stock indices are outperforming their US counterparts so far this year.
It's really interesting you talk about the UK being the forecasted second largest kind of, country in the G7 there. You mentioned some of the defense stocks there. Those are pretty much all large cap companies. Do you think some of that will trickle down to maybe some of the medium and small cap companies as well? Is that to be
I think
expected or?
so. I mean, it's worth noting that the FTSE 250, which has a lot of the mid cap stocks in the UK, that's also a very internationally focused index. It has, I think, more than 55%, nearly 60% um, of companies derive the large amount of their revenues from overseas markets. So, the global space is still really, really important for the UK, but it does go to show that there's some resilience in the UK, that even with these external threats that are going on and then the tariff risks, that UK stocks of all sizes could potentially do well. In terms of those stocks that are most closely linked to the performance of the domestic economy, I think it is going to be a bit of an uphill battle for some of them, some of those consumer stocks. Now, this is a bit of a global phenomenon at the moment because growth has started off on a weak note. We don't know where we are. There's the prospect that the Bank of England won't even be able to help the economy with interest rate cuts if inflation goes out of control. Now that's a little bit of a hypothetical at the moment. If the Bank of England, what would really give UK mid caps the biggest boost would be more rate cuts from the Bank of England. Right now, there's two rate cuts expected, but having quite a high neutral rate above 3% is probably not going to help a lot of households, a lot of consumer sentiment, but also these mid-cap businesses. So if the Bank of England, if we see tariffs come on board, maybe just for a short period of time, so they cause less uh, disruption to the domestic economy and to the inflation outlook, then that could be when I think the domestic focused companies, those consumer focused companies in the UK could really take off. I think we're going to have to wait though until Q2 to see how they're going to fare.
So just as a point of interest for the people who will be watching and listening to this, you mentioned there that the mid caps would benefit with rate cuts. Can you explain a little bit around why that is? Is that purely because it's the cost of borrowing, so more money to be able to invest into business? What are the main factors that would help them there? Just for the understanding of people who may be thinking, well,
Sure.
why is that?
I think there's 2 factors. So number 1, for, mid-cap stocks, a lot of them will rely on their growth will be funded by borrowing. So they need low interest rates because it reduces their cost of borrowing, which means that they've got more for profit. So if your debt servicing costs are lower, that's good news because you can keep more of your money that you earn for profits. So that's on one side, and that really impacts the slightly bigger mid caps, those more internationally focused mid caps. For the more domestically focused mid caps, where they benefit from interest rate cuts, is actually what that means to the regular person on the street. So if we've all got slightly lower interest rates, that means our borrowing, maybe our credit card spend, also our mortgages potentially, they could be lower. Those repayments could be lower if interest rates do fall in the coming months and years, and that gives us more money to spend. So particularly for those companies that are linked to consumption and consumer spending, that's how they benefit most directly from cuts in interest rates.
Brilliant. That's great. Thanks for explaining that. Do you see, we've spoken a little bit about, the UK and potentially Europe has kind of been mentioned there. What about emerging markets? Is there anything on the horizon or expectant in emerging markets potentially as an opportunity or areas where you think growth might be delivered
Yeah,
this
I
year?
mean, look, some of the best performing stock indices have been in Asia. Not everywhere. It hasn't been broad based, but certainly China, Hong Kong, they have really seen a massive increase. Now, if people say, well, China is not an emerging market, and I know it's not. But usually, what's good for China is good for the rest of the region. We are starting to see some fraying in the likes of Indonesia. Its stock market is really plunged on the back of growth fears. So, growth fears are very, very real, but there are some pockets of opportunity. Look at the indices that have really underperformed. So what we've got is like obviously China has underperformed, Hong Kong has underperformed. And what's great about those two indices is that they're really playing catch up because whilst their economy has been slow to pick up post COVID, they've obviously got their own thing going on in terms of AI models and tech. So their tech sector is really leading those indices higher. If we look at countries like Vietnam, a big exporter, so far it has managed to avoid tariffs. But I think we need to look at what the reciprocal tariffs could be for there. So I'd be a bit more careful about Asia ex Japan and ex China. I think Latam is an interesting dynamic as well, particularly what we're seeing in the likes of Brazil. So there's a lot of around, Brazil, for example, has seen sentiment data absolutely fall off a cliff. There's a lot of expectations about inflation going higher. In fact, they're expected to hike interest rates when the rest of the world is cutting them. Added to that, however, the real economic data is not nearly as bad as the sentiment data. So we could start to see a bit of a sentiment shift there. And likewise, South America itself can have their own trade routes. They also, export a lot of um, really key commodities around the world, and they're going to still be in great demand, particularly if people shun the US and start looking elsewhere. That could give the likes of Brazil, even Mexico, which seems like it's on its knees at the moment because of the way that the US is talking about tariffs with Mexico. But again, I think it's that what is if the US turns inwards, it has done this in other periods of history. The rest of the world can then forge those alliances and ultimately become less reliant on the US. So I would look at like Latam for sure. I like Brazil, even though I know it's got a lot of challenges. I just don't think the economic data is nearly as bad as what people thought it would be. I also think that China and Hong Kong have a long way, a much further way to go. And I prefer the bigger Asian economies rather than some of the other Asian economies who may at the start of the year benefited from China because China was largely the target of Donald Trump's tariffs. I think they're going to be the target in the second round of tariffs.
Yeah. And it's interesting because, yeah, some of those countries are actually in the BRICS alliance as well. So it also poses that question as well around how effective and how progressive they can afford to be in the coming years as well on the global kind of space, because they are a direct kind of a competition to the American dominance at this point in time, which you kind of alluded to in the first
Yeah, I
episode.
agree. I mean, look at India as well. It's less of an export-driven economy. So in that sense, a bit like the UK, it could be spared the worst of Trump's tariff threats. That could lead to its outperformance as well. Also, that there are signs that, people are getting a bit more interested in Russia again. Now, there's not much to invest in Russia, but the ruble is one of the better performing currencies in the world so far this year on the expectation that the war with Ukraine will end, that sanctions may be lifted. Now, I think that will take a much longer period of time than some expect, but certainly in terms of the ruble, it's worth giving that a look if you're very tolerant of risk, I suppose. But if we do see a peace deal between Ukraine and Russia, then we could see extra gains, I think, and further to go on the upside for the ruble.
Yeah. Thanks for that. I mean, so with all the research and everything that you guys come into contact with on a day-to-day basis, and I know that the information can be absolutely vast. Here's the important question for you, just for those who are watching who may be thinking about XCB. We're hearing more and more about you guys. How does this feed in to the decisions and the things that you actually do for clients? Because there's a lot of information, but knowing what to do with it is a completely different thing. So, how does that feed into what you guys do on the investment front for clients?
I mean, absolutely. Look, it's up to everybody to make their own decisions about how and where they invest their money. But, we provide actionable trade ideas. And I think context is everything. So if you're looking at markets, if you've got £100, say, and you want to put that into a market, well, maybe if you read the research, you'll say, right, well, I won't necessarily put all of that into just one stock or one, region. I might spread that around a little bit. We have plenty of research. I mean, you've got research on all types of products that we offer, whether it's commodities, great commodities analysis on our site. We've also got, market updates, but throughout the day as well, so that you're seeing what's going on in real time. Also, as most of your listeners and watch viewers will know, Peter, it's key events around central banks, around key economic data releases. We are on top of all of those. So it's about providing that context.
Yeah, context is really is the most important thing. There's so much out there. There's so many ways in which you can interpret it, but what's the context around it? And unfortunately, when you hear like news snippets, they often miss the all important context that make it make sense or make it a piece of information that you either take a knee jerk reaction to or you make a more considered kind of consideration on. So, yeah, thanks for that. But like I said, thank you so much for joining us, Kathleen. As a last kind of leaving message for this video and this episode, again, you're probably hearing more and more and more about XCB. I've been working with them now. This is my second year. They're all in one low cost platform to help you invest in ETFs and stocks. It's a really super simple, streamlined offering. If you look at their investment plans, you can literally just set up your plan. You can put whatever you want into it. Yes, you need to understand what you're doing, but they've got huge education and informational pools that you can actually pull on there. And you can just set your investment strategy and you can just leave it. I know that your money is there invested for the long term. Obviously, tax efficiency is king. It's really, really important to use your ISA allowances to make sure you can grow your money over the long term, benefit from compound interest, whilst enjoying the tax-free benefits of that. And they do have at the moment a really great offer where they're offering 6.5% on uninvested funds for 90 days. After 90 days, it goes down to 4.5%, and that is a variable rate based on the Bank of England. Because if the Bank of England base rate goes up, goes down, like all other interest rates, you'll see that adjustment as well. So if you are kind of investing at the moment, and perhaps you're looking at everything that's going on, you're thinking maybe I want to take some money off and put some money in cash. What better place to have it than a place that's going to give you 6.5% for 90 days? I think it's a pretty compelling offering. It's very, very competitive on the market. I'll leave a link down below so you can actually check them out. But again, Kathleen, thank you so much for joining me.
Thanks so much for having me, Peter.
Thank you. And we'll speak to you again next time. Cheers, guys. Catch you later.